Hey, welcome. Today, we're going to break down one of the most powerful and honestly most accessible tools in the entire world of investing, the index fund. We're going to get into how you can use it to build a seriously diversified portfolio. So let's dive right in. So let me just ask you, do you think you can beat the market? It's the big dream for so many investors, right? To find that one stock that just takes off, to outsmart the pros on Wall Street and see those amazing returns. It's a great thought, but how realistic is it really? Well, here's a little dose of reality for you. Get this. A whopping 80% of professional money managers, the people who do this for a living, full-time, they fail to do better than the overall market average. So if the pros can't consistently pull it off, what does that mean for the rest of us? The odds are, well, they're not great. Okay, so if trying to beat the market is pretty much a losing game for most people, what's the alternative? Well, that brings us to a much simpler and, I would argue, a much smarter way to invest. Let's talk about index funds. So what on earth is an index fund? In the simplest terms, it's a fund that automatically buys all the stocks in a specific market index. You've heard of the S&P 500, right? It tracks the 500 biggest companies in the US. Well, when you buy a single share of an S&P 500 index fund, you instantly own a tiny piece of all 500 of those companies. Just like that. And that simple idea leads to some huge advantages. You get instant, broad exposure to the entire market. That means your diversification is incredible. You know that old rule about not putting all your eggs in one basket? This is that rule on steroids. And all of that helps reduce your risk. The cherry on top, these funds have incredibly low fees. When you really look at it, these are two totally different philosophies. On one side, you have stock picking. It's a ton of work, constant research, and it's super high risk because you're betting on just a few companies. Plus, the fees can be really high. On the other side, you've got index funds. It's a low-effort strategy that just aims to match the market's performance, spreading your risk across hundreds of companies and keeping those costs super, super low. Now let's talk about the power of numbers, because this is really where you see how index funds build so much resilience in your investments. The magic is all about strength in numbers. So think about an index like the S&P 500 again. That's 500 of the biggest American companies. Now, could you, as a regular person, afford to go out and buy shares in all 500 of those companies individually? No way. It would be insanely expensive. And that is the exact problem that index funds were created to solve. So how do they do it? It's actually pretty brilliant. The fund pools money from thousands and thousands of investors just like you, creating this one giant pot of cash. With all that money, the fund can easily go out and buy every single stock in the index it's tracking. So when you buy just one share of that fund, you're effectively owning a small slice of everything. And this is where that resilience becomes so clear. Look at the 2008 financial crisis. If you were in an S&P 500 index fund, yeah, you would have seen a scary drop, about 38%. But by 2018, that same fund had climbed a staggering 325% from that low point. Individual companies can and do go bankrupt, but the broad market, historically, it has always recovered. This is the key takeaway, right here. The power of this strategy is all about time. Because markets go up and down, you need to have a long time horizon. We're talking at least 6 to 10 years, maybe more, to ride out those dips and capture the long-term growth. This is not a get-rich-quick scheme. It is a build wealth steadily strategy. Okay, so you've got the basics down. Now, let's talk about how you can sharpen your strategy a bit, because you don't have to just track the entire market. You can actually buy index funds that are laser-focused on one specific industry. Things like technology, finance, energy, consumer goods, you name it. So if you feel really strongly that a particular part of the economy is about to take off, this lets you invest in that idea while still staying diversified within that sector. You can then mix and match these sector funds to build a really interesting, diversified portfolio. So, for example, you could put some money in a tech fund, some in a finance fund, and some in an energy fund. You're creating a balanced strategy that taps into different parts of the economy. What you're really doing here is creating these amazing layers of diversification. First, you're diversified inside each fund because you own lots of companies in that one industry. But then you're also diversified across different industries. So let's say your energy fund has a really bad year.
Well, maybe your tech fund has a fantastic year, and it helps balance everything out. It's a really smart way to manage risk.
But hey, here's a quick pro tip for you. You have to look under the hood. Make sure you know what companies are actually inside each fund you own. You want to avoid accidentally buying the same stocks over and over again. For example, if you buy an oil fund and then a broader energy fund, chances are you're just buying a whole lot of the same stocks twice. Okay, let's bring this all home. Let's talk about the winning move and why this idea of just matching the market is actually so incredibly powerful. At the end of the day, the core idea is just so simple. You get the market's average returns, which, by the way, are historically pretty darn good, and you get them without all the stress, the high fees, and the endless guesswork of trying to pick winning stocks. It's all about getting solid results with the least amount of effort. So let's go back to that 80% number one more time. If most of the highly paid professionals can't beat the market, then matching it, well, that's not an average result, is it? It's an above-average result that you get with below-average effort and cost. Matching the market isn't settling for less. It's a strategic, proven path to winning in the long run. And that really leaves us with one final thought. In a game where almost everyone is trying and failing to be extraordinary, could it be that the single smartest move you can make is to just embrace the simple power of the average and let the market do all the heavy lifting for you?